Hi, everyone. Thanks for joining us. This is Dan Weisskopf, the ETF professor, also lead ETF strategist for the ETF think tank. Today, we're going to be talking to Tony Arsta, and we're going to have a great conversation, and it's a follow-up conversation, which makes it even more intriguing. And Tony, if you recall, is with Motley Fool Asset Management. Tony, we're going to give it a couple of seconds more, maybe like 20, 30 seconds more, let some people in. And of course, just know that this is also live streamed. And a lot of people listen to it on Twitter. So Tony, speaking of which, tell us a little bit about yourself and how you came to Motley, and, a bit about the culture there. Thanks.
Yeah, sure. Thanks for having me back. I'm at Motley Fool Asset Management, and I have now been here for 16 years. So it's been a long time being at the company. Originally, I got my undergrad degree in computer science and thought I'd be a programmer before I realized I was not good at that at all. So I went and got an MBA, studied finance, and started working at the Motley Fool. 2008 is when I started at the Motley Fool. 2009 is when we launched Motley Fool Asset Management and launched our first mutual fund, which is now an ETF. We were one of the first firms to convert a mutual fund to an ETF. And I've been working on that product, which is now called the Global Opportunities ETF. It's had a few different names in the past, but I've been working on that since 2009. Alongside that Global Opportunities Fund, I also work on many of our other products, including our mid-cap growth ETF and some of our passive products like the Fool 100 Index ETF, as well as a few others. So I've been at the company now for a long time. My entire investing career, to speak of, it is all at this company. Prior to that, I was trying to get my foot in the door doing computer work and not being successful at that. So, this is a company that prizes the culture of wanting to learn more, wanting to research and figure out what we're owning, being primarily business owners first instead of stock traders. So the fact that my initial education was not in finance, but was in a totally different field actually helps with my curiosity and my passion for owning great businesses. And I think if you look at our team across the board, you'll find that with many of the people I work alongside.
Yeah. And everybody's in different locations. Principally, is that correct?
We've got our main company headquarters is in Alexandria, Virginia, just outside Washington, D.C. I'm located just outside of Denver. We have an office in Denver, and I'm up in the mountains, along with our CIO, Brian Hinman, is located in Denver as well. So most of my team is in one of those two places, either near D.C. or near Denver. But yeah, we have people working for the company all over the U.S.
So your firm did the conversion. Congratulations. You were challenged to do it in some respects because you were either the first or the second firm to do it. You also have a combination of products that are both active and passive. We're going to be really talking mostly about global active, but speak a little bit about the Fool 100 as you mentioned before, TMFC, just so people know about it. Because, listen, it's $750 million, and I'm really kind of surprised sometimes that people don't know about it, especially given the performance.
Yeah, it's been doing very well, given its market cap weighting and some of those top names there. But I mentioned that I had started at the Motley Fool in 2008 before we started Motley Fool Asset Management in 2009. So Motley Fool Asset Management is a separate company, but we're really built on the same investing philosophy of finding great businesses and owning great businesses. The Motley Fool Publishing Company created these indexes. The Fool 100 Index is the largest index. And those are based on the work of that publishing company and the 40-plus analysts that work on that side of the business. So my role with Motley Fool Asset Management is just to take that index and passively apply it. So it is a passive index. It is a passive ETF, but it's based on the work of those analysts that work for that publishing business and are doing write-ups and picking stocks all the time. So it's kind of a weird hybrid of active stock recommendations by a publishing newsletter that is then turned into an index that we passively follow. So the performance has been quite good. I know I'm not supposed to talk about performance, but it's an index that is the 100th largest market cap based recommendations within that Motley Fool publishing universe. So it's market cap weighted, very passive, but it gives you those best ideas rather than just being an index like the S&P 500 that is not necessarily having that same analytical approach done to weed out companies. And it's also very different from the active products that we manage, like the global fund that I'm managing, where I actually get to pick what's in there. With TMFC, it's following along with what that publishing company is doing as an index. But yeah, it's a totally different challenge managing that. But I'm glad we have that product in our portfolio for potential clients.
And just one last question about it. It rebalances quarterly, monthly, annually?
It is a quarterly rebalance. There are some items in the methodology that prevent over turnover, having too many positions change, but it is a quarterly rebalance. So new ideas will get in there every 3 months.
Okay, so now we covered that. We also want to talk about the 4 pillars, because I really want to, during this whole conversation, put the 4 pillars into a context, right? You talk about it, but I don't know that everybody understands what the 4 pillars are. So walk us through what the 4 pillars are, and then we'll get more specific on how they're actually used.
Yeah, it would be hard for me to really go into any specific company without leaning back onto these 4 pillars. So it's important to understand that's how our process works at Motley Fool Asset Management. I mentioned that we like to be business owners and not stock traders. So a part of that is identifying what we view as high quality businesses. There's a lot of different ways to invest. You can buy cheap companies that are undervalued, that may be mixed quality, but we like to look for businesses that we know are high quality, could have long-term compounding results. And then through that, we're able to create a portfolio that we believe has a chance to outperform in the long run. So those 4 pillars, the first of those is management, culture, and incentives. So that's looking at not only the leadership team of a company, but how that leadership trickles down into the entire culture of the business. So how do they compensate their sales team, for example? How do they compensate the everyday employees versus compensating the executives? What kind of stock option programs do they have? Also within that management culture and incentives, we look at things like capital allocation. Are they overly aggressive with leveraging up the balance sheet with debt? Are they investing wisely in the business, returning cash to shareholders, or using it to try to grow an empire? All of those things fit into that first pillar. So that one's a little bit more on the qualitative side. It's easy to have a discussion there that isn't focused on numbers, that it is hard to really replicate through just a computer-based Excel model. So that's where the art of investing comes into play a little bit more. The next 2 pillars do kind of cover the quantitative side a bit more. The second pillar is economics of the business. So that's where we look at things like margins, return on capital, growth rates, all the classic things that you learn in your financial accounting classes and investing classes about how a business makes money and how that accrues to shareholders. The third pillar is competitive advantages. So that's the classic Warren Buffett moat, just the idea of what is hard to replicate about your business. What can a competitor not do with a big pile of cash? So that one is kind of a mix of qualitative and quantitative. You do see it in the numbers a lot of times. There's a lot of overlap in these. It's hard to really separate that competitive advantage from the margins that you can earn as a company. If you're a commodity business, you'll have low gross margins. So there is overlap there, but competitive advantage, we looked at not only what advantages a company has, but how durable and lasting those are. And then that brings me to the fourth pillar, which is the trajectory. So that is over the next 5 years, 10 years, and beyond, what does the company look like going forward, and what does its industry look like? So there's a few aspects there. One is a company can just do better if it's in an industry that's growing. If you're in a dying industry, but you're a good company, that limits your possibilities. If you're in a growing industry, you can do even more. If there's more competition coming in, if there's nothing that's durable about what you're doing and someone else can come in and replicate, then that trajectory of the business going forward is a lot more average looking as opposed to maybe what you look like today. So we try to analyze every company we look at and every business through those 4 different pillars. We have a discussion about each of those, and we assign a score of 1 to 5 for every company that we follow. And that's the basis and the starting point of how we choose what's in the portfolio. We want to know the quality of the company we're following. Once we determine a company is high enough quality, then we'll get into things like valuation and how big of a position to make it in the portfolio, how the overall portfolio management and risk profile of the portfolio is impacted. But everything starts with looking at that business and looking at those 4 pillars.
You mentioned Warren Buffett. So if sitting across the table, you were looking at Warren as opposed to me, how would you contrast your process versus what he does?
Well, I just read over the weekend the new Berkshire Hathaway annual letter, which I'm sure many listeners have read as well. He's always got great nuggets of wisdom in there, but there are different ways you can approach something and still be successful. One of the things he wrote again this year, which he's said in the past, is avoid permanent loss of capital, do not lose money. And I think that's a big difference between running a business like Berkshire Hathaway versus managing a portfolio. The reality of this portfolio is if a stock goes down in value, some of our shareholders are going to sell our ETF and make that a permanent loss of capital. So I can't, I'm holding on to my own shares in the ETF, so I know for me it's fine, but we can't behave in a way in which a decline in share price doesn't matter. So there is a little bit of a difference in what we're doing. My view of things, and I know I mentioned this last time, is that I take the kind of multiverse approach to multiple future realities that could play out and how we need to be prepared for more than one of them. If I am so set in my beliefs that I think we have to own this company because it will deliver a great return for us, there is a version of the future in which I was right, but there's also a version of the future in which I was wrong. So I view my job as building a portfolio that is robust enough that I'll get some decisions right, some wrong, and overall things will work out well for the shareholder versus the Warren Buffett view of never lose money. Rule 1 is never lose money, which I don't disagree with that, but it's hard in practice to actually turn that into any sort of investing philosophy that has a chance to outperform anything.
So you're a global investor. So is Warren these days, of course. What are you seeing in the way of numbers of opportunities in your universe? Is it wider than it has been in past years or narrower?
I think what we're seeing now is more differentiation. So in the past, it was we find a new company, we like the company, but is it really better than what we already own? I think what we're seeing now is that valuations are, there's a couple of trends at work. One is just the idea of index investing and passive investing. So things stay in proportion to each other. If all you're doing is passively following an index, that breaks down a bit when you start to get some of these mega caps that increase in value more. But the other side of it is that active investing still does have a place. And the more we have momentum and volatility in the markets, the more room there is to differentiate. So I think since we last spoke about 5 or 6 months ago, I think it was, we've sold 6 positions from the fund, which for us is extremely high. We tend to have low turnover, but we sold those because the opportunity, the valuation just isn't quite as good as some of the other things we're seeing. whether that's some new positions we've added or increasing our allocation to companies. We're seeing a lot more room recently. Selling 6 companies in a 6-month period is very rare for us, but I think that kind of speaks to what we're seeing right now, where there is a chance to rebalance that portfolio and put it into some things that are attractive. We're seeing a bit of an AI bubble, you might want to call it. Debatable whether it's a bubble or not. You never know until after the fact. But at the same time, we're seeing small and mid-cap U.S. companies. We're seeing European companies that are just, investors are uninterested right now, and we're getting some great opportunities at those.
Let's go right into what you sold in recent days. How does that process, work through your decision making? Right. We were talking about it earlier. How a name comes into the portfolio through the pillars and allocating amongst your group who does the analysis isn't necessarily, or does it necessarily work the same way on a sales of an investment?
Yeah, so the sell discipline and the reason for selling can be multiple things. The easier one that I'll get out of the way is Splunk, which is being acquired by Cisco. So why not sell that now? It's only about 1.5% away from the acquisition price. There's other companies like Medtronic, for example, that we've held for a very long time, and they're a very stable business that makes medical supplies. We still think there's a long-term future there. But we're seeing some smaller and mid-cap companies that we think have better upside potential and more room for growth. So selling Medtronic was more a case of opportunity cost. We needed the cash to buy some of the newer things we're seeing, as opposed to an idea that we've kind of soured on. One that we talked about last time, and I kind of defended how our thesis had changed and we were hanging on to it, is PayPal. And we did sell that out of the portfolio. So I think that is a good illustration of how our sell discipline can work at times. Our lead analyst on that particular company, Nate Weissar, has followed it for a long time. I had been a bull on the company going back to its IPO, and for a long time it had been a very good company that was getting good results. Things started to change and fall apart, and we kind of modified that thesis and did not choose to sell because we thought the price reflected what was available in that new thesis. And the company has continued to struggle. They recently hired a new CEO who came out with his vision of what he sees for the future. And that's where it becomes a collaboration between that lead analyst and the portfolio managers. And we're not really seeking to decide who's right or wrong or come to a consensus. We're seeking to make sure we have all the information and that we're not missing any relevant facts there. So with PayPal, it was a case of those 4 pillars that we look at kind of deteriorating. The management and culture, anytime there's a CEO change, you have to put a little bit of a flag there. So we had to acknowledge that and still held onto the stock last year. When we look at the competitive advantage and the trajectory, that's really what has changed in our view, or at least our assessment has changed since we last spoke. What we're seeing is a company in PayPal that is still very well positioned, still has a great competitive advantage. And we think that within the next couple of years, they'll be fine. They'll be able to figure things out, get their business in order. But what we're seeing in the meantime is people like Apple, for example, and their Apple Wallet platform, and some of these other things like blockchain technology, where the competition is not sitting still, and it's going to take PayPal a while to figure out what they want to focus on, get their product suite in order, and that ripples through that competitive advantage and trajectory in a way that we were just uncomfortable continuing to hold it. We think there's better opportunities right now. We will continue to follow the company, and I wouldn't be surprised if in the next few years it finds its way back into our portfolio. But the fact that they're kind of retrenching right now and competition is not sitting still is really what pushed us there to decide it wasn't a good fit for the portfolio right now.
Yeah. So this is the second time I've heard from one of you guys that, when there's a management shakeup, you have to review the culture. For me, when I was looking at PayPal, though, if somebody's coming in new as a CEO, don't you have to expect that they're going to shake things up, especially in a situation like this where he's a relatively young CEO? Doesn't mean he's not very well experienced, but the growth rate of the company, to your point, had been slowing, right? And innovation is required in terms of turning around their business. So it's funny because I think about you all as very patient investors, but you didn't want to take the risk of execution in this case.
Right. There's a difference between shaking things up and coming in with a new approach and completely ripping out the old system and putting in a new system. And I don't think PayPal's ripping out the old system, but every situation is unique, and you need to look at what's actually changing. To go back to an old Warren Buffett quote again, he wants to own a business that anyone can run, paraphrasing the quote, because at some point you'll lose that great leadership. And that's what it's hard when we're looking at these pillars, because we do believe that we want to own companies that are not reliant on a single individual, but at the same time, these single individuals can create tremendous wealth for investors. So yeah, every situation is different. I think the big part of it for us is we don't want our quality ratings to be static. We want to review all of them all of the time. There's the real limit to the amount of time we have to do things. My team consists of 9 people, so we can't literally review every single company every single day, but the more we can get to a real-time analysis of what we're looking at with each business, I think that's what we're striving for. And a change of management is just a very easy, obviously things are going to change. We should review what we've said about this company in the past. And sometimes it's a major change. Sometimes it's less so.
So talk us through a little bit, generally the way your process works is you assign each different pillar to one of your analysts or portfolio managers. Everybody's got a review process to score things, right? And then on the sell side, that can be similar. But is the same person necessarily reviewing the same pillar that they previously thought the company was strong on?
Yeah, so our process is, with any new idea, we assign 4 people on the team that are not the lead analyst to look at each of the pillars. So I mentioned I'm part of a 9-person team, so I would assign 4 different people to look at one of the pillars. After we've done that work, then I would do a full thesis write-up, which I review and update at least annually. So this sell discipline and looking at the company of the future is not necessarily going to have that same approach of having 4 people assigned to a pillar. We've already done that initial work, and at that point it becomes more of trying to assess what has changed. We do reviews every now and then that internally we call our big-in reviews, which are the big positions that have a big impact on the portfolio. We pull in the entire team for that to make sure we're viewing things from every angle. So we have a few different approaches and processes, but the assigning 4 different people to determine the quality of companies is really the initial part. From there, it's on that lead analyst to update those ratings whenever they see fit. And it's on the portfolio managers to push for that and make sure the ratings are accurate and reflect all the information that we have.
Okay. So we've talked about the process. The output of the process in the fund that you manage is now you're invested in Ireland and Georgia and the U.S. Talk to us a little bit about how the country exposure evolves.
Yeah, we really are a bottom-up fund. So our benchmark, the FTSE Global All Cap, I believe is nearly 8,000 or so companies in that benchmark, and we have less than 40 companies in our fund. So we're definitely not benchmark huggers. We're not looking at the top positions there and making sure that we have a close tracking error where we're looking from the bottom up, trying to find what we view to be great businesses. Historically, we've always been about 50% US, 50% ex-US, and that's based on the headquarters of the company. So there's a few, Ireland, for example, has some companies. I mentioned Medtronic, which we sold recently, is headquartered in Ireland, but nobody views that as an Irish company. So there's a few things like that where it is a little bit misleading. There's a company called Atlassian. I'm not sure if you're familiar with them. They do software globally, but their headquarters is actually in Australia. So that's our only Australian exposure in the portfolio, even though practically none of their revenue comes from that country relative to their number of employees. So yeah, we have about 50% US, 50% ex-US, and we don't spend a ton of time overly worried about where a company is headquartered. We tend to look at that overall portfolio composition, look at where we're being exposed to things like revenue sources and things like that to determine what we want to buy. Every time we add or remove a company or change a weight in the portfolio, I need to look at everything we own and determine what risks we're being exposed to, what could go wrong that would really ultimately hurt us. And the headquarters of a company is less relevant than a lot of other metrics we can look at.
And by the way, Georgia isn't the state of Georgia.
Right. Yeah, that's the country of Georgia, which we've held that position for a long time, Georgia capital. But I was thinking the other day about our exposures to individual countries in Europe. The fact that Universal Music Group, as an example, is located in the Netherlands, that's not very relevant. I'm glad that with the U.S. side of the portfolio, I don't need to break out our exposure by state of headquarters, because that would be ridiculous. And I think when you look at the European Union, it's a similar thing. We have a company in Germany, a company in Netherlands, Spain. None of those headquarters locations are extremely relevant at all. Well, they're relevant in terms of the work culture, I guess, in a lot of those places, but that's the bigger part.
Yeah, no, that's valid. But what about the revenue stream in your portfolio? How does that break out?
Yeah, I was just looking at this, and I was actually surprised that it's not vastly different from where those headquarters are. So we've got about 50% of the portfolio in the US, but then another 11% or so in Canada. So overall, when I look at our revenue exposures, 55% of the revenue of the portfolio on a weighted basis comes from North America. So that sounds like, okay, you add up the American and Canadian companies and that's where you get it from, but that's not really the case at all. We look at a company like MasterCard, for example, which is a U.S. company. 30% of MasterCard's revenue comes from North America. The rest is international. So there's some, you can own U.S. companies and get some good global exposure. You can also own some good global companies and get U.S. exposure. There's a company in Germany called Simrise, which we bought back in October of last year, which does flavors and other additives and ingredients for foods. They get about half their revenue, about 30% of their revenue from North America. So you can invest globally and still get a very different mix of where your revenues are exposed to based on what you own. So again, I mentioned that anytime we buy or sell anything for the portfolio, I'm looking at what are the risks we're being exposed to, what are the overall weights. I look at, currently we own one business that's less than 2% of the portfolio that has heavy exposure to China. That's Yum China, which operates KFC there. But we've got many businesses that sell into China. So we look at that exposure, for example. And then some of it, there's easily accessible information, and there's harder to get information. So I can tell you that right now, just the numbers that can come onto my screen easily, that 18.5% of our portfolio revenue comes from other locations. But a big driver of that, for example, I mentioned 30% of MasterCard is North America. If you look at their segments in their annual report, they say 30% North America, 70% other countries. So that's not helpful at all. I actually find it easier to break out the exposures of our international holdings than our U.S. holdings because of we have several U.S. companies that are that obscure about where their other revenue comes from.
That's interesting. A recent purchase that you all made was in the Nintendo.
Yep.
Walk us through Nintendo in the context of your peers, your pillars rather.
Pillars, yeah. Nintendo's a fascinating company that I could talk about for hours. Like partially because of the business and partially because I just grew up playing the games, as many people globally have done. But yeah, the company started 130 years ago as a playing card company. That's not extremely irrelevant, but in 1977, they hired a man named Shigeru Miyamoto, who is known as the creator of Mario, the creator of Donkey Kong, the creator of Zelda. He's really the driving force and innovator of everything at that company. So he's 71 years old right now, and he's been at the company since 1977. So he is the culture. There's CEOs and presidents of the company that have come and gone, and there's a lot about that business that we like, but he is the driving force. And his philosophy when he created games like Donkey Kong and Super Mario Brothers back in the early 1980s was he wanted to create things that were fun to play, not necessarily that had the best hardware or overly complex, innovative stories. It was all about being able to sit down and have fun, incorporate family time into that. So that has really been the culture. And he's 71 years old, still involved in every game that's made at Nintendo, still involved in the decision process. He mentors the young developers of games, helps them along. So everything about how they view creativity and coming up with something new and fun, putting that customer first is all thanks to him. So that's one of the areas where I will be curious. I believe they built a strong enough culture that when he's no longer working there, the culture will survive. But that is, for my entire lifetime, he's been such a driving force behind the culture there. The economics of the business, going to our second pillar, is also interesting because of how things have changed. You look back in the past at the video game industry, it was all about selling hardware. So with the original Nintendo Entertainment System in the 1980s, the company wanted to sell hardware, make all their money on that, and then they also made games, had other companies develop games so people would buy more hardware. Over the next 20, 30 years, that changed a bit where there was more money to be made from the games themselves, but hardware was still a big driver of revenue. You still had a cyclical business as a new game system would come out every 6 years or so. And now what we're seeing in these last few years is more and more of the business being driven by subscriptions, by a digital online, you pay a monthly fee to get access to games. So the hardware and the physical games are still a big part of it, but we're seeing more of a shift away from this cyclical business to a more steady platform subscription-based approach. So that's a win in our book. I think they're a very good company there. The third pillar, competitive advantage, I mentioned the characters of Donkey Kong, Zelda, Mario. Those are household names that everybody knows. There was a Mario Brothers movie this past year that came out much better than the movie I remember from the 1990s with the Mario Brothers, which was not much needs to be said about that. But the competitive advantage is a couple things. You have that intellectual property of the characters, but you also have a reputation of the company itself. People trust the Nintendo brand and the Nintendo platform for family-based entertainment. You look at Xbox and PlayStation, for example, there's games like Call of Duty where you're shooting guns at each other, and it's a lot more... there's some of it on all the platforms, but there's a lot more adult gaming in terms of violence on all these other platforms that Nintendo has historically shied away from. So that does give them a big advantage there as well. People like their technology. They like the fact that the Nintendo Switch is innovative compared to either you have a mobile game or you have something you can plug into your TV. Nintendo chose to upend that by creating the Switch, which is both. You can take it on the road and play with it, and then when you get home, you plug it into your TV and you can have that at-home experience. So one of the things people talk about quite a bit with competitive advantage is the first mover advantage. And I always like to flip that and talk about the late mover advantage. I think that's an underappreciated advantage for many companies. We could shift into talking about AI and how a late mover advantage might be useful there in the coming years. But with Nintendo, what we're seeing is that the Nintendo Switch is cheaper than the Xbox and the PlayStation. They use, bluntly, they use inferior hardware and chips compared to the PlayStation and Xbox. They use equipment that's not as good to keep that price lower, so more families can get involved and play it, sign up for the subscriptions. So I think the idea of getting an off-the-shelf part and making a system rather than competing on the cutting edge is a competitive advantage that most people overlook when they're looking at that pillar. And then in terms of trajectory, I already mentioned moving more towards a subscription business where the hardware is less important. You're looking at just a lot more stability if somebody's paying $10 a month as opposed to $60+ to buy a game whenever they can afford it or find a new game they like. You just keep them on that treadmill of buying the latest game. The Nintendo Online platform with the game history and stats of all the players is something that keeps you locked into that ecosystem a little bit more. And when we look at Nintendo compared to competitors, Sony and Microsoft are already making more money per user with those digital subscriptions and online gameplay. So Nintendo is kind of catching up there, which gives them more upside and more room to grow. So everything about the business, from the culture on down through the intellectual property and the trajectory of the business, rated out very highly on our analysis of the company.
And you're a gamer too, right?
It's been a while since I played games, but I have played since I was young. And when I say it's been a while, it's been a few months. It hasn't been years since I've last picked up a controller.
Yeah, it's kind of like a portfolio manager who has a low handicap probably isn't working hard enough, right? You know, in terms of golf, obviously. Yeah. So we were talking earlier, and I guess there's a company called Carey Group that has been recently added to the portfolio. Again, go through the pillars with that decision, because I think it puts the whole process into context.
Yeah. So Carey Group is a company, you probably come across them most in the grocery store when you see like the Kerrygold butter brand. And they still have that dairy business, but that's a small part of their business compared to the additives business. I mentioned we bought Simrise late last year, which is a very similar company. Both Simrise and Carey Group create things that go into food and provide different flavors, different textures, different shelf life characteristics. And it's fascinating because it's in pretty much any food you buy in the grocery store is going to have one of these additives in it, but it is such a small part of the overall cost. And I think that's why we are drawn to these companies and why we see that advantage. You're not talking about a big piece of what drives the value of the end product. You're talking about something that adjusts the flavor profile a little bit and is just easy for a company to keep in the product once they've started using it. So looking at the culture, management culture and incentives for Carey Group, they get dinged a little bit on my opinion because they continue to hold on to that dairy piece of the business that does butter. And in Ireland and the UK, they do other dairy products. That's a much worse business than food additives. Actually, trying to sell dairy products, the margins are lower, the cyclicality, the commodity pricing, it's not a good business at all, but they continue to hang on to it because of the legacy of the company, and they believe it gives them a bit of an R&D edge. So we do dig them a bit in that category, but they're a company that they hire a lot of people that work in the the chemical engineering type space with food science, and people go to work at Carey early on in their careers and they stay there. The tenure of the employees at Carey is very high relative to the rest of the industry. On the economics, I already mentioned that it's good when your customer doesn't view your product as a very large piece of their overall bill of goods. It's something where Carey can easily pass on commodity price increases and pass on their costs to the customer. They do operate a little bit differently than others in the industry that try to take a little bit of a price gain every time. Carey really does push through the inflation that's hitting them, but doesn't push through much other pricing. They prefer to partner with these companies and just keep getting into more and more products and let that work for them. So their margins have actually come down a bit as inflation has gone up in the last few years because they're unwilling to take more pricing than just that inflation piece. Competitive advantage is built on how they've acquired what they call technologies over the years. So they'll use the term technology to refer to any bit of food, like something that makes food sweeter is one of their technologies. Something that makes food more savory is a technology. And then things like processing, like baking of food, emulsifying, they have this entire platform of different ways they can enhance a food that they call their technology platform. And they work almost as an outsourced R&D for food creation, where companies that want to make a food product will come up with the idea and then work with Carey to really build out the best possible way to add the elements that they want to the food, add the flavors they want, add the textures they want. And they work in partnership with these companies. And then over time, they trust that Carey will only really pass on the inflation cost and continue to partner with them. So it's a very stable and sticky business once you get your foot in the door. And in terms of trajectory, that one's a little bit tougher because of how, I mean, we've all been eating food forever. That's not a new innovative industry. However, we are seeing plenty of innovation when it comes to healthier ingredients. We're seeing processes that are better for the planet, more climate-friendly processes, more health-friendly processes. There's plenty of things that they're doing to really make the overall product better for the health of the world. And then they're pushing further into emerging markets as well. I think their goal is by 2026, if I'm remembering correctly, to have their products reaching 2 billion people in emerging markets around the world. And they're around 1.5 billion people in emerging markets today that they reach. So the more you can put little additives in food to improve the experience and potentially even improve the health of the end users, that's a place we want to be. And since it's such a small part of the overall cost of food, we think they're pretty stable with what they do.
So with a company like that, I get why you like it, and I get the benefit of their ability to pass along the increase of inflation to their customers. What will happen in your mind when inflation dies down, all right? And will they lower their price as well, or not likely, right? It just maybe their margin expands.
Yeah, their margins have always been very good, so they don't. I'm actually not sure off the top of my head what they do in a deflationary environment. They tend to keep those price changes pretty small. So you're talking about 1 to 3% a year, with inflation being a little higher. These last few years, it's been more pronounced, but it's generally a pretty small part of the business. Where they really see their top line growth is in helping companies create new products, being a partner with these companies. So one of the areas they're actually growing that I didn't mention the trajectory is historically, when you look at food, the big dominant companies got all the shelf space in grocery stores. Now that we have Instagram and influencers and we have online buying and we just have a changing, shifting world in that regard, these big dominant companies are less important, and you're getting more boutique, smaller companies that are creating a couple products and really trying to sell those more direct to consumer. And that's where Carry is really starting to shine, is their ability to partner with these companies early on in the product development cycle and really build themselves into these products. So that's where it's the old products that exist, they'll keep their margins pretty steady there, but the more new products that come out and the more new things, there's always a chance to reset the pricing whenever you partner on a new product.
So now we're going to transfer over from food to talk to us a little bit about Rentokil. And how'd you find yourself in that business? And what is that?
That's one of my PMs, Mike Olson. He likes to look at a lot of these random UK companies that he thinks are well positioned. One of the things that Mike will mention is talk about fragmented businesses and high cost intensity. So the way we characterize Rentokil is that it is a very so it's a pest control company, extermination, etc. So he calls that a business that has a very low barrier to entry, but a very high barrier to scale. So if you look at the top 10 companies that are in the pest control business, they account for 70% of the overall industry. And then the remaining 30% is extremely fragmented. It's small mom and pop businesses, usually based around a city where you just need somebody to go out to your house and help with the pest control. But it's a business that doesn't sound glamorous. It's not glamorous at all, but it is very durable, very recurring. Most people that use pest control services are on a recurring payment plan, and they just keep it once they have it and never get rid of it. A big part of that is commercial properties, but there is domestic as well. So Rentokil is fascinating because of how they've grown their business. It is a very fragmented business that's easy for people to get into, but hard to scale. So since 2015, they've made over 200 acquisitions of these small companies. So let's say I decide to open a pest control business in the mountains here in Colorado, and I grow it a little bit, but I can't scale it up from there. Rentokil would buy a business like that and tuck it into their overall operations, get better margins because of the scale that they have. And they've grown successfully for a very long time doing that. More recently, though, they acquired Terminix, which is a brand that most Americans will be more familiar with. Terminix is a very large company, and that was a very complex deal. And one of the reasons this company made it into our portfolio now is because the results from that deal are not looking great so far. People use the term synergies all the time when there's a big acquisition. Where can you remove costs? Where can you consolidate operations? And so far, Rentokil has done a fairly poor job of integrating Terminix and growing the business to the degree that they thought they could. Given that they've made more than 200 acquisitions since 2015 of smaller companies, we believe that they can eventually get this one right and get all of the operations integrated, that it's just taking longer than we would expect. Right now, the company is about a 30% share of pest control in the U.S. and 20% globally. So they're very big and very stable at what they do. And we're just seeing this opportunity because they've tried to make a large acquisition and stumbled a bit on it. So this one's a little bit different, where we don't really view the some parts of the management and the trajectory are a little bit more questionable because of this stumble with Terminix. But if we believe that they will get back to where they were in terms of a management that has followed a playbook for a very long time in terms of integrating smaller businesses into their overall operations, the economics of the business are fantastic since it is such a recurring business model. The competitive advantage I mentioned already with the low barriers to entry, but high barriers to scale, and they're already one of the largest in the world. And then that trajectory, if they can get these operational issues with Terminix fixed, we think there's an ability to just return to the valuation they were at in the past, and that would be a win for us.
Yeah, I mean, I sense that acquisitions are something that your process incorporates as upside, just generally. And I say that because Comcast is also in your portfolio, right? And listen, Brian has had many acquisitions in the history of the company. Talk to us a little bit about Comcast and how you view that one as well.
Yeah, that one, the stock is about flat since we bought it. And really our initial thesis there was, and we're seeing this now with how they're marketing themselves, that they're switching from being a media company to a broadband provider. So they've already built out a big network and have a lot of broadband subscribers around the U.S. that they've historically called part of their cable subscriber package. So you had cable TV, but then you also had cable modems and cable internet. They're kind of abandoning that cable terminology now because cable TV is, put it kindly, it's not growing. You can argue about what the end case will be as we get, the cost of subscribing to all the streaming services now is so high that somebody's going to bundle those eventually, and then we'll have the new version of cable. But regardless, the business and our reason for buying it was based on broadband internet. I personally don't have cable TV at my home, but I have a high-speed internet connection, and I stream movies and TV and whatever I want to watch. So that's where the future is in having those pipes going into your home. That was our initial thesis, at least. I think what we've seen recently is story time takes a lot of precedence in terms of what the biggest threat is to cable and to broadband. And the latest thing is T-Mobile really pushing this idea of wireless internet, wireless broadband, and putting boxes in the home that use the 5G cellular network to really try to compete with these fixed lines that cost a lot of money to lay down, and whether or not 5G can ultimately compete with Comcast. I think what I've seen is that T-Mobile is doing very well with their wireless internet, but it is a fraction of the size of what the big internet providers, broadband providers like Comcast currently have. So yeah, the stock seems to be under a little bit of pressure right now, but it is a company that our thesis has always been that the TV business is suffering a little bit and perhaps dying, but people will always need broadband. But then there's plenty of upside when you look at Universal, and the that media business could be worth more than zero, which would be a tremendous win. I always like these ideas where if things are not terrible, we can make money. So if Rentokil doesn't totally screw up this Terminix deal, then we'll do all right there. If Comcast can just continue to do what they've been doing in broadband, and then the TV business is worth more than zero, like that's just an extra optionality for us. I like businesses where I only have to be partially right for us to not get harmed by much.
No, I've been in the ETF industry for 25 years. And title, the only area I think that we don't really directly participate in the ETF world is indexing. MSCI is a holding of yours. What a dominant force. And we don't try to do indexing because it requires so much scale, right? To your point, right? And a lot of expertise, and it's very hard to displace a dominant force in a particular industry like that. Talk to us a little bit about MSCI, and then unfortunately, we're going to have to wrap this up.
Yeah, MSCI has a very stable traditional business of making people pay for a license for the indexes that they provide. And that's a great business. I've referred to them in unkind terms in the past in terms of how you can't really run a product with a benchmark and not pay either them or S&P or one of those guys a decent chunk of money. So that core business is very stable. People are always going to be paying to have a benchmark, frankly, because the SEC requires every fund out there to have a broad-based benchmark that they compare themselves against. So it's mandated legally. But we've seen growth in the business in other areas as well. We see more asset-based fees as they create kind of bespoke one-off indexes for ETF managers that do want, just as an example, like a biotech index. They go to MSCI and say, create us an index of 50 biotech companies that rebalances twice a year, and then we'll put the MSCI name on it and sell this ETF to the world. And they collect somewhere on the order of 2 to 3 basis points of assets for all of those ETFs out there that exist. So as the market grows, as the value of the investable market grows and ETFs grow with them, they'll take their fees. Then aside from that, they're growing well in ESG and climate. They've actually split climate out from the rest of ESG because it's growing so much. And that's one area where it's been a little controversial with the US politics and everything lately, but over time we're seeing more and more people using those products. And this is where the real optionality kicker comes in with MSCI. We've seen climate in the past be part of ESG as just a thing that investors are looking at. There's the potential, as people look at carbon emissions, that every company in the world may have to pay for their carbon data in the future, and not just investment companies, but every company out there will need to report. I think the SEC tried to put that in what companies have to report in their annual reports about carbon emissions, and that's currently working its way through all the legal systems. But if we have a future where everybody has to pay for MSCI data as opposed to just asset managers, that's even more money that a company can make through government mandate. So I speak unkindly about the business sometimes, but it is a wonderful business to be an owner of.
Yeah, it really is. Tony, thanks very much. For those who want to learn more about PFMG and any of the funds, they can go to foolsetf.com and learn more and continue the dialogue. Thanks very much, Tony. It was great. Great hearing the story, hearing the process.
Thank you. This was fun.